Ancient India had its own Desi version of risk capital financing. Wealthy merchants would pool their financial resources and support some of the younger ones to expand their operations and get a share of the profits. Ancient scriptures also suggest that some temples would often utilize their gold reserves as venture funds to finance traders and artisans. Interestingly, the founder of modern venture capital was neither a banker nor an entrepreneur. He was an army man, General Georges Duriat, a World War II veteran who set up ARDC, American Research and Development Corporation, in 1946 to finance private enterprises set up by ex-military personnel. "20 years later, ARDC made super profits in digital equipment, and since then, venture capital as an asset class has only grown from strength to strength over the years." In 1985, while venture capital was almost 3 decades old in the US, there was still no signs of its birth in socialist India. 1985 began as a year of hope and expectation for Indians. A massive electoral mandate catapulted a 40-year-old Rajiv Gandhi into becoming the youngest Prime Minister in Indian history, and a resurgent Indian team won the World Championship of Cricket in Australia. The new government's economic policies were more pro-business, a clear departure from the past. The private sector was finally given some push. Computerization was encouraged, and the telecom revolution had just begun. Narayanan Vagul was then the chairman and managing director of ICICI, India's premier project and development financing institution. He had recently taken charge after a distinguished stint as chairman of Bank of India and had already acquired a reputation as one of the outstanding corporate leaders of his times. In June 1985, Rajiv Gandhi embarked on his first sojourn to the United States, a meeting with the US President Ronald Reagan to herald a new future for Indo-US ties. Let's now meet the legendary Narayanan Vagul, the founder of Indian Venture Capital and a Padma Bhushan awardee, to discover how this trip triggered a series of events that eventually led to the birth of Indian venture capital.
It started with a political, Rajiv Gandhi and Reagan went into an agreement in 1985 when Rajiv became the Prime Minister. It was known as an agreement known as PACT. It was an understanding between the USAID and ICICI, because ICICI was identified as an agency for that. The option, they gave $10 million to this ICICI to be invested in funds which involved Indo-American technology. That was in fact the origin of the venture capital, because it gave me an idea, namely, if this is the way in which going forward, why don't I start venture capital movement in India?
He quickly went to the US and to the heart of venture capital Silicon Valley. His mission was to strike a partnership with some of the well-known NRI entrepreneurs and venture capitalists and launch an Indian venture capital fund.
So the first thing I did was to go to US and meet a lot of people, particularly in the Silicon Valley. I remember one person whom I met, Vinod Khosla, who was perhaps the father figure for even at that time in venture capital movement, 86, he was a very father figure. So I wanted to know whether he could really join hands with ICICI and think in terms of starting a venture capital. But they were not interested. They were willing to talk to me, but they were not interested at all in India. And as I identified the first few companies, I decided that regardless of whether it's success or not, I'll start a company on their own.
As soon as he returned, Vagul lost no time in setting up the venture capital desk at ICICI. He handpicked Kiran Nadkarni, who was part of a special projects team at ICICI, to lead this initiative. Let's now meet Kiran Nadkarni, the first executive of the Indian venture capital industry and ex-MD of ICICI Ventures.
So I started the business of venture capital well before we founded TDICI. I initially ran it as a division of ICICI, as a one-man department. After running this business for about 18 months as a division of ICICI, our chairman felt that it is better to spin the whole business out into a separate company. One, because it didn't attract top management attention because of the small volume of business, and it required a different, complete mindset to make small investments.
Let's now meet Gopal Srinivasan, chairman of TVS Capital, a third-generation member of the illustrious TVS family, who has founded, steered, and scaled over 10 ventures and played an extensive role in the evolution of the Indian venture capital and private equity regulatory landscape.
That time, venture capital was actually called a term loan. So we put a small amount of money and they gave us a large amount of money. And they also took a kicker. They could convert that 10% of their equity, of their loans, into equity at par. I don't know, the words at par are forgotten. But when your market price was 50, 60, 70 rupees, they would get a 10 rupee share. And when we go back to ICICI and its term loan business, and to some extent Mr. Nadkarni also went IDBI, but IDBI also, that was really, if you ask me, the real venture capital of that era.
At this stage, Vagul made some bold moves, decisions that would have far-reaching implications. Mr. Pramod Chowdhury, founder-chairman of Praj Industries, is our next guest, and he explains how tough the business environment was during the mid to late 1980s when Praj was started.
The word startup wasn't even coined in 80s, leave alone conducive ecosystems such as incubators and investors. Thus, venturing into business was akin to swimming against that stream. Hence, the challenges were plenty. Let me explain a few key challenges briefly. In developing this project, we almost exhausted all our funds. Though Sprung was a new and innovative idea, it was untested and not yet commercialized. The customer payments were contingent of the success of the technology, which made it tough even for bankers to fund. Belonging to a middle-class family and being a first-generation entrepreneur, I did not have enough resources at my disposal then to shore up the business.
By 1988, optimism on the new India began to fade. The Bofors scandal hit the headlines, and the Rajiv Gandhi government was in turmoil. The resignation of then Finance Minister VP Singh heightened the political tensions. The much talked about reforms had a pause.
At that point in time, India was a period where we never had confidence in ourselves. We were completely, we were like that late teenager who knew he had capability but had complete lack of confidence, and was actually going through a slightly depressing period, right, because of the economic crisis. It was a very formative stage of India But at the same time, in some sense, you could argue that's where this today's India was born.
Even private companies, if they had to raise money, equity from investors at a price 25% higher than the par value of the share, they would have had to get approval from CCI, Controller of Capital Issues, which would easily take over 6 months during those days, and a few visits to Delhi.
However, in those turbulent times, the fledgling Indian venture capital industry found a new friend, Melvin Goldman, a senior executive at World Bank, and went all out within the World Bank setup to push India's case.
They told you what the price of the shares was going to be, period, and let alone a premium. I mean, and so it was not only, it was a terrible constraint in India, but it also constrained the bureaucrats in the World Bank to say, hey, why are we getting into this? The Indian government said, well, the Indian government won't permit your venture capitalists to sell off their shares and to be successful. You can imagine the skepticism of many in the World Bank.
Meanwhile, Vagul was in the process of setting up the ICICI Ventures headquarters. In the late 80s, either Mumbai, Delhi, or Chennai would have been the popular location, but Vagul preferred Bengaluru.
So I looked at Bangalore, where the Institute of Science was there. And at the time, ISRO was also there in Bangalore.
He felt strongly that Bengaluru was a hotspot for innovation, and a business like venture capital needed such an environment to thrive and be successful.
So in some sense, I think Mr. Vagul, given his vision, I think not only saw talent, but he also felt that talent would like to live in a city like Bangalore, right? And Bangalore had one hidden advantage, which I think we are now seeing, is that even in that era, people in Bangalore were not hardly from Karnataka. It was always. So its ability to attract very diverse ethnicity and make them feel very comfortable saw not only ISRO and BEL and HMT and BHEL or whatever else, but I think he also saw the fact it was a welcoming climate for a wide range of talent and make them feel at home.
By 1988, Melvin Goldman had managed to convince his bosses at World Bank to sponsor 4 Indian venture capital funds, 3 new funds, and ICICI Ventures, which was already operational.
We started with 4 VCs. At that time, TDICI was already formed.
Yes.
So TDICI, I mean, Vagul said his attitude, I remember him very, very well. When I met with him, I said, Mr. Vagul, do you mind? We would love to work with you if you'll permit us to work with you. But we'd also like to help set up some more venture capital. He said, in India, there's room for many. This was 1988, early 1988. That was the kind of person he was. Okay. I mean, it was never from him personally. In other words, he really had a national vision.
Now, let's meet J.M. Trivedi. Trivedi was part of the founding team of Gujarat Venture Finance Limited.
So when World Bank approached GIC and invited GIC to start venture capital, I got associated in writing the business plan for starting a venture capital company. And over a period of next 2 years, with extensive effort and negotiations with GIC, between GIC and World Bank and other institutions of Government of India, finally GVFL took shape.
At this stage, we must highlight the role of Vishnu Varshne. He was the first MD of GVFL. Unfortunately, he passed away in 2009, but his contributions to Indian venture capital will never be forgotten. But World Bank was conscious of the multiple pulls and pressures that government-backed venture capital funds could face, and promptly put in checks and balances, as Mel explains.
We insisted on the management companies being independent, though, of the finance corporations, because they had too much public sector involvement, and particularly at the state level, like Gujarat and Andhra Pradesh. And the way we worked was the first 5 investments that they made, we had to approve in Washington.
Now, GVFL had a couple of unique aspects. Its charter did not have any geographical restrictions, and so they could invest across the country. Secondly, well-known corporate groups were encouraged to join as shareholders in the AMC.
The leadership of GIC at that time was quite visionary, and they decided that not only it should be a separate company, but private sector enterprises should be invited to participate in the ownership of GVFL, as well as to invest in the funds managed by GVFL. And therefore, a number of private sector companies also joined this effort. Zydus Cadila, Torrent are a couple that I remember.
As we dug deeper into the events of that period, we discovered that 2 senior bureaucrats had played a crucial role in paving the way for World Bank's investments in Indian VC funds. Coincidentally, both went on to become governors of Reserve Bank of India. One of the early success stories in Indian venture capital was from an unlikely industry, engineering services.
To seek financial aid, I used to spend almost 4 days a week in Mumbai, meeting different bankers, private financiers, and even state bureaucrats. One such evening on my way back from Mumbai, I came across an article in the magazine carrying a cover story on ICICI venture capital scheme. The next day, when I visited ICICI office in Bombay, I met Mr. Kiran Narkani, who heard me patiently and was quite taken by the idea of Spranny. He himself was an engineer. Impressed by the merits of my case, a team of professors and scientists from UDCT and BRC evaluated Spranny and voted in favor of Praj. A conditional loan cum equity was sanctioned by ICICI, which lifted us from the sinking spirit and helped us successfully develop the technology. Later on, they even considered supplementary funding till the final testing. The entire funding happened in the span of 6 to 8 months.
In mid-1991, India was in crisis. The tragic assassination of Rajiv Gandhi shocked the nation. India was also confronting a major balance of payments crisis. In July 1991, the then Prime Minister, P.V. Narasimha Rao, and his Finance Minister, Dr. Manmohan Singh, stunned the world by announcing a wide-ranging set of economic reforms. The reforms triggered a euphoria in the markets. The stock markets were on a roll, hitting all-time highs. Allowing free pricing of shares was a shot in the arm for both the capital markets and the young venture capital industry. Let's now meet Naru Narayanan, an entrepreneur who raised venture capital twice for 2 different businesses from the same fund.
I went back to TDICI, I said, here I am. And they said, no, we do only technology products. And I said, listen, this is a technology product. So how is it a technology product? And I said, well, people fall ill, they take medication. This medication has got to be dosed out in small bits and pieces. Sustained release of medication is what I offer. By putting it into gum, you are able to do that. We managed to replicate the product repeatedly with the same characteristics that we desired in the beginning. And that is the difficult part. The machine kept having some problem or the other. And we were not a machine making company. And no potential franchisee could sustain the fears and uncertainties that this threw up.
Let's now welcome Chandrasekhar Kandaswamy, who joined ICICI Ventures in 1989 and was part of its core team. Chandra recalls why ICICI Ventures struggled initially backing very early stage companies.
When we started initially, we used to go and tap into these research organizations like Indian Institute of Science and IIT. The idea was to see if you can identify technologies which could be commercialized for the markets. But I think very quickly we realized that model was not working out for various reasons. I think probably we were too early to the market, so some of these technologies were not even become commercialized, and then I think it had a long gestation period of bringing to the market. Markets are not ready to accept.
Around 1991, ICICI Ventures made a strategic shift to focus on more established companies. And Vagul credits this smart move to Kiran. And this strategy shift coincided with the abolition of CCI and free pricing of shares. Till 1991, all venture capital funds in India were public sector. Post-liberalization, it was now time for the private sector to play its part. Let's now meet Sanjay Kulkarni, co-founder of 20th Century Finance, who has the distinction of setting up India's first private sector VC fund.
In 1991, the government of India came with guidelines for starting venture capital by private companies. And interestingly, the guidelines stated that a financial institution should hold an equity higher than that of the private company. So we started a company called 20th Century Venture Capital Corporation in 1991. In this company, we had 20% equity. ICICI had 20.5%, and Mr. Vaghul, in fact, was the chairman of this company. And we had some very marquee investors called, the ADB and IFC Washington.
Our next guest is Parag Dhol, part of ICICI Ventures' core team in the early 1990s. Parag recalls those early days when it was tough to convince promoters to look at venture capital as an option.
The industry used to manage $50 million. That's an M, not a B. And it was such a small industry. I remember we used to go out calling people, telling them that you should take equity to rapidly grow your business, grow it faster, much faster than you can do while bootstrapping and all of that. And 2 out of 10 times, people would ask us, what interest rate do you charge? So you can imagine how early those days were.
I think we did about 11 workshops across several cities to educate, members of CII and talk to them about, what kind of funding options are there, what kind of businesses can get funded, and things like that.
In the early 90s, venture capital was still very nascent in India. There was no playbook, and fund managers had the unenviable task of learning on the job. It was here that World Bank stepped in and arranged for training in some of the leading US-based venture funds. Chandra recalls this experience.
So I had the opportunity to get trained in a firm called Poly Ventures. I was there from August 93 till December 93, sorry, and had a great time during those 6 months. I had the opportunity to be part of the entire evaluation process. So, right from how the Monday meeting, partner meeting work, to attending their investor conferences, to be part of various evaluations, and how they term sheets work, and how they work with portfolio companies, and what sort of value add they provide.
From God's own country and the city of Trivandrum, we have our next guest, M.R. Narayanan, founder of Transmatic Systems, a telecom products company. And he tells us how he spotted venture capital in the early 1990s.
We had started Transmatic Systems in Trivandrum to manufacture telecom products. At that time, when we started, the telecommunication field was getting more open. So we sold also a lot of them to the telecom department. And that is when we came to know about venture capital. Till then, in the 90s, nobody had even heard about venture capital. And we came to know about TDICI in Bangalore and approached them in the year 91 and had sent our expansion program to them. So after a few meetings, they were kind enough to grant us a small amount as venture capital, whereby the 10 rupees share of our company was sold at a value of premium of 15 rupees.
Let's now meet Nitin Deshmukh. He joined ICICI Ventures in 1989 as part of its core investment team. Let's listen to his interesting story on how they backed a team of passionate techies from Godrej Group to come out and start a new venture in the early 1990s.
He was basically, they were doing CAD/CAM software. This was a part of the division of Godrej. I happened to speak to him about venture capital and how we could actually help him and support him, where he would actually come out of, they could actually come out as a team out of Godrej. Actually, that was the sort of led to the creation of geometric software.
Pradeep Kaur is our next guest, founder of Microland and a pioneering tech entrepreneur. Pradeep fondly recalls his 1992 deal with ICICI Ventures.
Microland was founded in August 1989. Early days of the IT industry. In the initial stages, our business model was selling local area networks. In 1992, there was a need to find a new VC firm who would buy the equity of SBI Capital Markets. And that's when we approached TDICI. I remember meeting Mr. Vagul, who was a tremendous, inspiring business leader. And when I remember going to his room, he used to have this large screen next to his sofa, which had all his, I would say, all his appointments there, and would sit across, and I shared with him what we plan to do for Microland. And he said, we will consider investing in Microland. They trusted you. There was very, very little, I would say, background or reference of what an upside could be. It was more an investment on belief. It was more an investment on trust. It was more an investment to say, go start your venture. We will support you. We are with you.
In the early 1990s, ICICI Ventures was a relatively insignificant part of the ICICI balance sheet, and in normal circumstances would not have attracted much mindshare from the senior management. But the visionary Vagul knew early on what its future potential was and how crucial it would be to nurture it closely in the formative years. The mindshare he gave venture capital was at that time disproportionate to its balance sheet contribution. Our next guest is P.R. Srinivasan. PRS was also part of the core team of ICICI Ventures in the early 90s. He fondly recalls Vagul and his senior team's commitment to the fledgling venture capital business.
So Vagul, who was the chairman of ICICI, and Javeri, who was the number 2, both of them used to come to Bangalore to hold committee of directors meetings. This I'm talking about early 90s, this is before private airlines. Only Indian Airlines was flying in those days, and Indian Airlines had one flight in the morning from Bombay to Bangalore and one flight in the evening. So, and ICICI had this policy of not letting Vagul and Javeri in the same flight. So Vagul used to come in the morning and Javeri had to come in the evening, and then we used to have a committee of directors meeting, And then next day morning, Vagul will fly back. And next day evening, Jhaveri will fly back. So basically, a committee of directors meeting took 2 full days for both these people to spend with us. But they took that effort because they knew that the VCP industry was very important, and they invested and trained us.
It is a very interesting phase where I used to come very regularly to Bangalore. Every proposal used to be discussed by Kiran with me. And we had a very simple board. I don't think I brought in any of the outsiders. I don't remember who the board members were, but basically it was an executive board. We took several wrong decisions. We took quite a few right decisions also. Our learning experience was enormous.
Deal making in that era was very different, but perhaps less complex and time consuming. There were no big four accounting firms, no consultants, no lawyers. Most of the evaluation and diligence was in-house, with a few exceptions, as Nitin Deshmukh explains.
So in terms of diligence, I think our primary diligence was led by the team members themselves. I think we had that kind of philosophy where we had taken professionals with industry experience. Primarily, they led the diligence process by connecting to experts in the industry and talking to them about any particular opportunity, any serious opportunity at that point of time that they wanted to pursue, taking inputs from the industry experts.
We never negotiated terms. All these term sheet negotiation, legal negotiation that we do now, they were non-existent in those days. We pretty much, dictated the, not even dictated is not the right word. We printed whatever we wanted in the shareholders agreement. We told the promoters to sign.
The process typically involved setting up an advisory committee. So for every proposal that was very serious, we would actually do this kind of entire checks on the industry, basically validating the business plan of the company by talking to the experts. And then also, of course, I should add to that, we also did extensive checks on the background checks on the promoters.
And you remember most notably that when he used to sign on a sheet of paper, the signature would go from one end of the A4 paper to the other. And I began to take that as a rule of thumb to test somebody's ego. So whenever I wanted to find out if I could invest in somebody and to get some sense of ego on a scale of 1 to 10, measured widthwise across A4, I would ask them to sign somewhere. And that would be an excellent indicator. Keep that in mind and take that as serious education.
It's not that venture capital was a bed of roses for fund managers of that era. There were plenty of disappointments and failures. Patience and perseverance was tested multiple times. But as Vagul observes, they were prepared for the long haul.
Initially, we encountered only failures. It was very difficult for us to find. So we used to discuss a lot whether the failures is because we were not tech up to us the business, or whether it is inherent in the ecosystem. What is really causing that failure? In fact, the first investment that you made was a failure. And I used to grieve over that. Me and Natkan used to sit and discuss what is really happening.
What went wrong?
And we seem to have made a mistake in respect of that. But I thought over a period of as we gained experience that this is going to be natural in the industry. You're not going to have a high strike rate. The strike rate would be 3 out of 10 or something like that.
Having said that, I think there was a lot of learning from those projects that we had. The investment committee was also very supportive. Our trust committee was supportive. Of course, Mr. Vagul was always there to back us despite all the setbacks that we went through. And we moved on from fund to fund.
By 1993, venture capital activity picked up in the country and many new funds were set up. Deal activity was largely confined to the top metros, with Bengaluru, Mumbai and Chennai dominating, but other cities were also chipping in. India's tryst with liberalization and reforms was finally paying off by mid-1994. Inflation was under control. Forex reserves were overflowing. Over $2 billion of foreign investments had come in over the last 12 months, and the stock markets were on a roll. Indian entrepreneurs were now thinking big. The market now had the need for larger checks of equity capital and foreign capital too. Venture capital alone was not enough. It was time for venture capital's younger sibling to take center stage: private equity. Stay tuned for part 2 of this series, where we trace the evolution of Indian private equity, meet the pioneering fund managers and movers and shakers of that era, get deeper insights into the vision and organization building style of the legendary Vagul and some of the marquee deals of those times.